this is a real turning point for the markets right now. This is going to be one of the most important videos this month. So pay attention because we are going to be covering a lot of things. We're going to be dividing this video into 4 parts. Part number 1, why are stocks going down right now? Part number 2, what's the long-term picture in the markets? Number 3, how healthy this market actually is. And number 4, how we are currently positioning ourselves right now. So let's get right into it. Point number 1, why are stocks going down? Now we all know that corrections along an uptrend are normal. We had one during the month of June right here, and we're having one right now. Stocks were going up massively. We were in a huge rally. So seeing a correction after such a rally is actually a very good thing. Stocks don't go up in a straight line. They go up, then they go down, then they go sideways for a while, then they go back up again. That's called a trend. So apart from this being a much needed correction during an uptrend, we do have some worries in the markets right now, pushing the markets down in the short term. First of all, the stimulus package that the markets were expecting has still not come. It seems unlikely to get a stimulus deal until after the election, which is definitely later than expected by the markets. We've also got the Federal Reserve calming down their balance sheet expansion. Right here, this huge expansion in their balance sheet went from $4 trillion to $7 trillion in just a month. This was during the health crisis. This is what fueled a huge part of the stock market rally during the past few months. And you can see since around May right here, we've actually been going down, while many investors actually expected the balance sheet to continue increasing throughout the months after the actual shutdown. So the markets are starting to get a little bit uneasy. We've been talking about a blow off top in the markets all the way to the 4,000 point range on the S&P 500, a very steep move up to a long-term market top. But a big part of that blow off top would be fueled by liquidity coming in. So should we be worried? Can the markets collapse down back to the March lows because of a lack of liquidity? To answer that, we're going to take a look at the longer term picture on the charts. So this is the weekly chart of the S&P 500. This is the bull market of 2009 to 2020. And you can see we're building major divergences on the RSI. You can see right here, we've got price making a higher high, price going up, while the RSI is actually making a lower high. That tells you that momentum is slowing down on the long-term time frame. And we can go back on the chart right here. You can see every major top in the markets, 2008 right here, was accompanied by similar divergence. We had divergence in the RSI at the top of the 2008, and same thing with the dot-com bubble right here. We were building divergences throughout this entire period. Now keep in mind, this was a 2-year period right here, building divergences throughout this entire period. So right now we are building a top. We are pricing in a potential top in the coming years, but that does not mean we have seen the top just yet. We know that the long-term outlook for stocks is not good. We're at the end of the 10-year bull market. The economy is fragile and over-leveraged. We're starting to price in a top in the technicals, but that does not mean that we saw the top just yet. So that's the long-term picture. We're looking for a top, but we're also looking to profit from the liquidity coming into the markets right now as much as possible, because the markets could potentially still have much room to go before ultimately topping. We don't expect to time the top perfectly of the bull market. In fact, 2008, you can see right here, it's very rare that you'll be able to time a top perfectly. You're going to have to wait for a breakdown of long-term technicals, crossing that 100-day moving average right here. Then as the market backtests, fails the backtest, that's when you can short right here. Right now, as we speak, There is no reason to short long term. We can make small trades if we see opportunities, but having a long-term short right now is way too early. But it's never too early to drop a like on this video to help push the content out to a larger audience. So if you like this content, if you enjoy what we work on and what we put out, don't hesitate to do so. And we thank you very much for doing that. If this really is a long-term top, we're going to see a big collapse back below the 100-day moving average. Then again, a back test, and that's when you strike. That's when you short the markets long term. That's what we tried doing right here as the markets were back testing the 100-day moving average, but it ended up being a false breakdown and the markets popped back up. And that's when we knew the Fed was in control. The panic and the fear is postponed, and we immediately started looking for a run up to the highs and potentially a blow off top coming. So point number 3, how healthy is the stock market right now? And to answer that, we're going to take a look at the RSP. This is something we're looking at closely, especially with this recent correction. The RSP is the S&P 500 equal weighted ETF. So we've been talking about this. This is the same stocks as the S&P 500, the same basket of stocks, but equally divided between each other. The S&P 500 looks like the same basket of stocks, but instead of being equally divided, you've got maybe 50% of the index that are just composed of a handful of stocks, and then you've got the rest of the companies. And so you can see what's been happening with the RSP. It's been a very shallow correction. This does not look bad at all. And the rally off the bottom of this correction has been much stronger on the RSP than on the actual S&P 500. And to show you exactly why this matters, we're going to take a look at the RSP divided by the SPX. And this is again something we're taking a look at very closely recently. We started talking about it right here as it was bottoming at this support level right here. And we said that this chart would likely rally off support because the tech stocks were overvalued and the RSP was undervalued. And so we had sector rotation. You had the big guys taking profits from their tech stocks and injecting it into the RSP, and you get a rally in the breadth. This is very healthy. This is good to see, especially when stocks are correcting. It means that money is still staying into stocks, that the big guys are still bullish on stocks. And as long as money is flowing into stocks, that's good, because we are going to get more stimulus, and we are going to see the Federal Reserve continue to expand their balance sheet. Now, it may not have happened just yet, but it is inevitable. If they don't do it, we're going straight for a depression, and they know it. So more liquidity is coming, and as long as that liquidity is flowing into stocks, the rally is going to continue going. Now let's overlay the S&P 500 on this chart. Can stocks still go deeper before turning around? Absolutely. Just because we have good breadth on this correction doesn't mean it can't still drop another 3-4% before turning around. It just means that this is likely just a correction. It doesn't tell you when it's going to be ending. So that's exactly what we're going to discuss in the next point, how we're positioning ourselves and where we think this correction is going to be ending. So we're on the daily chart here. This is the futures chart. If you want to access this chart, you can click the link in the description for our go-to charting platform, and it is the ticker symbol US 500 for the futures chart of the S&P 500. This gives you what happens overnight. It gives you what happens over the weekends. So you get much more data, a broader and more accurate technical picture of what's actually going on. So right now we're looking at this trend line. We've been looking at it for a while, and we've been testing this trend line for a while. We're still above it. We still haven't broken this trend line. So this is an objective buy, as long as you have a stop loss. Because what do we have here? We've got a flagpole, a consolidation, and if we break down below this consolidation and below this major trend line, we're going deep and straight down to the 3,200 point level. So that's why you need a stop loss, because this is a major trend line and you do not want to see the price lose that trend line. If it does, it's not the end of the world. We still have support, major support right here at the 3,200 point level. And we're going to be looking to re-enter at that level if this breakdown happens. We still believe that the fundamentals are in favor of more gains coming in the S&P 500. Now you can absolutely do a short trade on a break of that trend line, but don't chase the breakdown. It could end up being a false breakdown, a quick candlestick wick, and then a bounce back up. This is what happened right here. You had a false breakdown below that trend line. The market bounced back up, and that was a major buying opportunity. So again, if we have that kind of scenario, a breakdown, a pop back up, that's a major buying opportunity. Look at the green candle that we had after that. That's called a short squeeze, and it actually led to a major move up in the markets. If you're looking to short, you're looking for a breakdown, a back test, and as the price starts to reject off that trend line, off that resistance, that's when you can short. If you're actively trading the S&P 500, you need to be very quick and you need to be prepared for every scenario. False breakdowns, false breakouts, back tests, everything. So we've established that this zone right here is a good objective buying opportunity. But we do have one more thing to watch on this chart right here. I'm going to put a trend line that we haven't looked at too much on the S&P 500 so far. It's a trend line that's parallel to the one that we're actually looking. And you can see it has many reactions along the way. And throughout the uptrend, the price actually uses it as support. That's been the case for a while. So what we're looking for right now for a bullish signal on this trend is for the price to poke its head above this trend line and start to use it as support. And that's when we're going to start seeing more of an uptrend like we did back here and start to head on and take out the highs. But right now we are still in that no man's land zone between the two trend lines, your own personal risk tolerance, and how you prefer to trade. If you feel safer waiting a little bit, waiting for a break above that trend line, seeing it act as support before buying, that is absolutely normal. And you have a lot more room before you start seeing big red moves below that trend line. If you buy right here, yes, it's a big opportunity, but you could easily see a big gap down or a big red candle the next day. So again, it's all about your own personal risk tolerance. Now that's about all we wanted to cover in this video. If you enjoyed, make sure to drop a like and subscribe to the channel if you haven't already. In the meantime, good luck on your trading and see you next time.